I've been actually looking around for a piece of research like yours for the last couple of days, just to try and understand if there's an oil embargo that could come quite suddenly, what happens to energy markets? And you lay it out very clearly. A couple of scenarios that you're looking at. What's worst case scenario?
Well, good morning, Francine.
Good morning.
Thanks for having me. I think there are really three scenarios we're thinking about. The central case is that a determined reduction in the West's reliance on Russian energy is now baked in. That's a done deal, regardless of what happens on the ground in Ukraine. There are risks to the downside there, as in a faster reduction in the West's reliance on Russian oil and gas. And you see this morning news from Europe about more determination to reduce imports of Russian oil and gas, and that would result in even tighter markets. We don't see that much risk of a less determined reduction now, regardless of what happens on the ground. So tight energy markets are here to stay, with risks skewed to the upside, we think.
So how tight can they be? If you look at, if there's a recession, and I don't know whether we're inching towards this with a lot of the sanctions, but also possible mistake from some of the policymakers, does it mean that automatically there's going to be demand destruction across the commodity spectrum?
Yes, I think so. And really what we're looking at here is a classic supply shock. Energy prices remaining high in tight markets. And although it's not the 1970s on a global scale, the world is less reliant on oil and gas than it was then. For Europe, the risks of stagnation now are very serious. Low stagnation, possibly recession as well, at the same time as high inflation. So Europe now faces serious risks of recession and stagnation.
So what's the right policy mix to deal with that?
Well, in Europe, the ECB can't really now be relied on, given that it's facing high inflation, to come to the rescue. All eyes really should be on fiscal policy. And although we saw some noise there a few weeks ago, actually we haven't seen plans forthcoming. Hence, we think the downside risk to European growth. The ECB is in a real dilemma now. Prior to this, it needed to normalize policy, get rates out of negative territory. The restart didn't need additional stimulus. But now the ECB may find actually that this slowdown that's coming, and you see it now in the PMI surveys, this slowdown that's coming may do some of its work for it. But there's no getting around the fact that the ECB faces a real dilemma here.
Alex, why do you think fiscal plans have been a little bit shortcoming, or they're certainly not forthcoming? Is it because it's a lost case scenario if there's some kind of oil embargo? Are they gaming worst case scenarios? Or is it after 2 years of COVID, they feel like they can't really spend their way through this?
Well, it's difficult to say. I think partly it's not yet clear the scale of the slowdown Europe is facing. I think when we look at this and crunch the numbers, we think this energy shock could knock 2 to 3% off the level of European GDP by the end of the year. So even with the momentum from the continued restart, Europe is getting close to zero growth on an annual basis.
So what happens to some of the energy supplies? I know we were talking about, the IEA putting extra stockpiles. We talk a lot about renewables, but again, we sometimes don't have the components to make that transition possible in the timeline that the EU has set out.
Yes, and so the main plan is the determined plan to reduce reliance on Russian gas imports over the next year by 2/3. But even with energy conservation measures, even with a delayed phase out of nuclear power, Europe will rely on increased imports of LNG from other sources. And really what we're seeing here, or going to see, is a shift in where fossil fuels are produced, away from Russia, where assets are effectively being stranded, and towards other places like the United States and Canada.
Are we underestimating this in the markets? Stocks are looking at metrics and they seem to be powering ahead. I know it's very difficult to get a return, so I understand their dilemma. But given what you're saying, maybe they should, have a bit of a correction.
Well, we remain overweight equities as a whole, but within that, we're not overweight European equities because we think this growth slowdown that we're looking at now in Europe isn't fully reflected in relative valuations.
Are we underestimating the political splintering? I know we have French elections, and in the last couple of days, that Marine Le Pen has been doing quite well. What are some of the secondary and third-time effects of this uneasiness in Europe that we're seeing?
Well, I think, first of all, we'll see European equity markets underperform for a period, hence why we're not overweight European equities as we are other equities. The uncertainty will persist for some period of time. I think what we need to look for is whether there's fiscal action, whether any fiscal action comes along, and we need to look to the ECB for signals about whether it still remains determined to get rates out of negative territory, even as growth slows.
So, Alex, where does China fit into all of this? I mean, a lot of questions about, of course, this maybe newfound friendship between Russia and China, but also China's diverging from the rest of the world in terms of some of the policies they're putting in place.
Yeah, I think two things about China now over recent weeks. The first is that downside risks to growth in China this year have increased. it seems that the cost of COVID control and the lockdowns is going to be greater than many had anticipated. And so the chances of hitting that around 5.5% growth target are now slimmer than they were. At the same time, we see increasing numbers of international investors demanding a higher risk premium for investment in China. Now, that's partly why a higher risk premium has been priced in so far this year, and we think that explains in large part the relative performance of Chinese stocks over the course of the year to date.
Do you expect them to stay with their zero COVID tolerance policy?
Yeah, I think so, but the definition of zero COVID is increasingly flexible.
Right.
But nevertheless, with an elderly population that isn't fully vaccinated, as say in the West, the Chinese authorities face a difficult choice. Where they have COVID outbreaks, they will need to be controlled as they are now in Shanghai, and that has a serious cost on economic growth.
Does it reshift? And I know part of our supply chains had already shifted under President Trump, but does it continue shifting because of what's happening in China? Yeah,
partly because of what's happening in China and partly because of the Russia situation as well. We will see, I think, a rewiring of global supply chains, perhaps into different poles, west and east, but that remains to be seen. What we are facing now is a world dominated by supply shocks. We've been through a period where supply wasn't the main factor. Post the pandemic, we're in a world driven by supply, and that presents central banks with a real dilemma, because either they have to live with higher inflation or they have to raise rates to levels that would destroy demand, raise unemployment in order to squeeze inflation down. And that's the dilemma they haven't really been faced with for a very long time.
And the Bank of England probably has it harder than anyone, so there's not much reliance on, Russian gas and oil, but at the same time, because of Brexit, it's more difficult to deal with inflation because you have labor shortages and so wages go up.
Yeah, the UK clearly faces a number of supply shocks. One, as you say, as a result of Brexit, the other as a result of rising energy prices and particularly gas prices. So the Bank of England has been, in the face of that, sprinting towards neutral, removing stimulus, which makes absolute sense, as it does for other central banks as well. The interesting question is whether the bank, and indeed the Fed, go further than taking their foot off the gas and actually slam the brakes to slow demand.